Alrighty, welcome to the monthly recap. So this is for today, ending May 31st, 2024. The most beautiful month, unfortunately, is in the rearview mirror now. Although it ended on a little bit of a crazy note with all the hail yesterday. I'm not sure what you guys had up in your neck of the woods, but got some hail by our house. So, anyways, on to June. June's another pretty month. I'll give it a little bit of grace there, but it's no May. Nothing holds a flame to May. Alrighty, so. May, Mother's Day. Happy Mother's Day for all those mothers. Memorial Day, Cinco de Mayo. Yeah, it was a pretty busy month with holidays. May in review, inflation is cooling, which is great news, but unfortunately, we got some bad news in that there's going to be a tough road to hoe ahead of us. I'm going to be talking about it a little bit more in detail here, but the reports that we're going to be replacing are much cooler going forward, and it's going to be tricky to make some progress. We got jobs reports, as we always do. Those showed some weakness. We got hawks and doves playing tug of war, so I'm going to have a little bit of fun with that. And then the Fed meeting and decision, they had that meeting on May 1st. And then mortgage rates, they actually had a pretty solid month. Because of the improvement on inflation, because of the weakness in the jobs market, mortgage rates did improve. A 30-year fix for some home buyer making less than 80% of the area median income. Rates improved from about 7.375 down to about 7%. So pretty good news with regards to mortgage rates as well. So let's get into it all. Starting with inflation. I know, Aaron and his inflation numbers. He loves inflation numbers, but I got to take a couple seconds. So Consumer Price Index, first of the three reports, the headline increased 0.3% in April, but the year-over-year figures improved to 3.4% from 3.5%. The core rate, which removes volatile food and energy from that equation, that decreased to 3.6%, down from 3.8%. So good news on CPI, kind of led the charge, started the month off in the right way. We also got Producer Price Index. That's wholesale inflation. Okay, so inflation is companies pay for goods, raw materials. They then repackage that, sell it off to the consumer. So the idea is that Producer Price Index can kind of be like a leading indicator for some of these other inflation metrics. Producer Price Index, headline increased 0.5%. That's at 2.2% year over year. Core increased 0.5% to 2.4% year over year. So those are actually really hot numbers, 0.5%. Like that's a pretty hot number. However, the reason this was perceived as good news was because the March PPI was revised down 0.3%. And if that had been reported correctly the first time, it actually would have come in at negative 0.1%. So it's only relative to the unadjusted figure that it was up so much. They had to go back and revise the previous figures down, and that actually made the numbers look much better. They're like, oh, well, yeah, up 0.5%, but if it hadn't been for this negative 0.3% revision, it only would have been up 0.2%. That's pretty solid. So all good news. And then quite literally today, personal consumption expenditures, PCE. So today we got PCE. The headline figure increased 0.3% in April, remained at 2.7% year over year. Core increased 0.2%. That remained at 2.8% year over year. For perspective, the Fed wants core PCE. So they want this 2.8% figure to reach 2%. That's really what their overall objective is. Okay. They want core PCE to hit 2%. I think we're going to actually see some more progress next month with regards to inflation. And there's actually a lot of anecdotal evidence. Walgreens, Walmart, Target, all of them have been cutting costs of their products significantly. I think Target alone said they were going to be slashing the prices on 5,000 commonly ordered goods because what they're finding is that with consumer debt being so high, with consumer spending savings being so low, consumers are looking for more ways to cut costs. Well, Target, Walmart, Walgreens, they're all feeling that pinch, and they've all started to lower their goods. So this can be deflationary in nature. So good news there. The problem is, the bearer of bad news here. The problem is when you look past next month's figures, okay? When we look past next month's figures, what we see that we're going to be starting to replace a whole lot of really, really low PCE numbers. I mean, in the 0.1%, in the 0.09% range, some really, really low inflation figures. So when they report year-over-year numbers, not only are today's numbers important, and they certainly are, but equally as important, if not more important, is the numbers that we're replacing from a year ago. And when you look at the numbers that we're going to start to replace here going forward, there are some really, really, really low numbers. So it's entirely possible this 2.8% could start to inch up closer to 3%. So yeah, the market's loved the data. Hey, great news on CPI, great news on PPI because of that significant revision. We'll take the good news on PCE even. It wasn't a surprise to the downside. It's trading water, but that's okay. We'll take it. The markets really, really liked it, which is why mortgage rates improved throughout the month. But then when we look past next month's figures, we start to see some really, really stubbornly low numbers that we're going to start to replace. And as we start to replace them with even slightly warmer numbers, it's going to start to cause inflation to likely tick up. Maybe we can start to get some really deflationary news. Maybe we start to get some negative numbers, but it's kind of unlikely. We'll see. But yeah, sorry for the bad news there. We'll take the good news while we get it, because after next month's round of data, there might not be a whole lot of good news on the horizon, which gets us to jobs. Okay, so jobs reported came in cooler than everybody was expecting. ADP has lately been coming in lower than BLS, and it's been reporting a more, soft jobs market than BLS has. This month, it was actually the opposite. So April ADP reported 192,000 jobs being created. Expectations were for 183,000. Then they revised the March report up by 24,000. So it was a strong number already. They revised the previous figure up. So ADP actually came in strong. However, BLS was a significant miss. BLS, Bureau of Labor Statistics, they reported 175,000 jobs being created. Expectations were for 243,000 jobs being created. In addition, they revised the previous two reports down 22,000. So unemployment actually increased from 3.8 to 3.9%. Now, all of this is important because of hawks and doves. Hawks and doves, hawks and doves. And right now what they're doing is they're playing Tug O War. I alluded to this in my monthly recap last time. I had a little bit of fun with AI image generators. Some of these hawks and doves playing Tug O War images are still like nightmare fodder for me. They've got some really, really weird images that popped up. But this is the best one we could find. So we got hawks and doves playing Tug O War. And here's what I mean by that. So there's hawkish members in the Fed, and then there's dovish members in the Fed. Okay, doves are nice and cool. They're polite. They have nice little tones. They're very, very mild-mannered creatures. And then you have hawks, and hawks are very aggressive, right? So when somebody is considered a hawk, it means that their primary concern is low inflation. Okay, they are more financially restrictive. They have a contractionary monetary policy. Okay, their goal is to hike rates so that people stop to spend money, and by doing that, it's going to start to bring inflation down. Their primary concern is lowering inflation. They prefer to keep rates elevated to keep that inflation low, and they're oftentimes criticized for being too restrictive and too reliant on one piece of data, which is inflation. Okay, doves, on the other hand, nicer demeanor, calmer demeanor. Their primary concern is low unemployment, right? They care less about inflation, more about just keeping unemployment low. They want people to be employed. They want the economy to be doing well. And their way to perceive how that happens is by keeping unemployment low. They're more financially accommodative. They have an expansionary monetary policy, okay? They prefer keeping rates low to spur economic growth. That's their primary concern. However, they are oftentimes criticized for potentially creating conditions where inflation can run rampant. Okay, so by being too financially accommodative, they can have inflation start to run away from them. Now, this is really important because there's two pieces of data. Like if we do have hawks and doves playing tug of war, what they are fighting over, the piece of rope itself is made up of jobs numbers and inflation numbers. Okay, and depending on what's leading the way, it's going to dictate who ultimately gets their position to be the position. Okay, who gets to gain that momentum? So if unemployment ticks up, hawks are actually going to become a little bit more dovish because they say, hey, look, while we want to keep inflation low, we also don't want the economy to be, held back too much either. So if unemployment starts to tick up and it starts to surprise to the upside, both hawks and doves are going to become a little bit more dovish. Okay. If inflation heats up, however, both hawks and doves are going to get more hawkish. Now, this is really interesting because in April, all the data was pointed to strong unemployment, okay? Unemployment numbers were ticking down, and stubborn inflation. Inflation was holding steady. So the hawks started to control more of the tempo, okay? Then in May, so this month, the data started pointing to weakening employment. I talked about the BLS numbers, how those came in significantly lower. And then we saw the unemployment rate tick up slightly, okay? And the inflation numbers were only positive. So if April was dominated by the hawks, May was actually dominated by the doves. Okay. And that's exactly the tug of war match we have going on right now. Now, I mentioned on the horizon, it's going to be very hard to make some meaningful progress on the inflation front. Next month still should be a good month for inflation. We'll take it if we can. But after that, it's going to be very hard to make meaningful progress on inflation. And if that's the case, all eyes are going to be on the jobs market. Okay. The Fed has come out and said, look, a surprise on unemployment is what would really likely cause us to start to look earnestly at cutting the Fed funds rate. And a surprise would probably be like in the 4.2% territory. Okay. So if we're going to see the Fed really start to really consider Fed rate cuts, it's going to require unemployment to start ticking up even more. I mentioned that the unemployment number came in around 3.9% this last time. Yeah, all things point to, if we're going to have a surprise on unemployment numbers, it's going to have to be more on the order of like 4.2% most likely for members to start really considering cutting rates in earnest. So let's get to the Fed meeting and their decision and the next meetings that are on the horizon. So the Fed left rates unchanged on their May 1st meeting. Those rates remain in a range of 5.25 to 5.5%. They always have a range. The minutes reflected a Fed that was really concerned with inflation. But then right after that, we started to get that really positive inflation numbers from PPI and CPI. And then all of a sudden, the Fed's sentiment started to shift. Numerous members came out like, we're not nearly as worried about it as our minutes said we were. The minutes were in that May 1st meeting. So it's amazing how quickly sentiment changes. Now, here's what's important. These are the remaining meetings of the year: June 12th, July 31st, September 18th, November 7th, and December 18th. Now, these dates with a asterisk by them. So June, September, and December. These are the meetings where they have a summary of economic projections. Okay, it's very likely that if the Fed's going to cut rates for the first time, they're going to do so in conjunction with one of these three meetings. The reason being, that gives them more of an opportunity to explain their decision. Okay. Now, after that, they could start to make some, rate cuts afterwards, but it's most likely that first rate cut is going to happen on one of these three meetings. Most traders had June 12th circled. They were like, hey, look, June 12th is when that first rate cut's going to happen. Because of how stubborn inflation has been, it's very unlikely that June 12th is going to be the date anymore. Okay. Sentiment shifted quite drastically on that too. Like at one point, it was like 70% of traders were expecting June 12th to be the meeting where that first rate cut was going to happen. That's significantly lower now, like less than 20%, I believe. Almost nobody thinks the Fed's going to cut rates in this upcoming meeting. So we start to turn our attention to September 18th. Okay, it's possible they could do it on July 31st, but it doesn't give them a platform to explain their decisions as much unless it's one of these three meetings. Okay, so September 18th is probably the leading candidate right now, but it's really going to depend on what the unemployment numbers do between now and then. I also want to talk briefly about Days of Our Congress, right? My favorite sitcom, not sitcom, right? Anyways, I mentioned on the last episode that current expectations are that Johnson had enough support to remain Speaker. Turns out that was exactly right. They tried to oust him as Speaker of the House. That failed. He is indeed still the Speaker. The budgets have been passed. The foreign aid bills have been passed. So all those story arcs have kind of come to a nice conclusion. Okay, we'll see what's in store for next season, but that's basically it for this season of Days of Our Congress. Let's look ahead real fast. Jobs reports. Next week is Jobs Week. I mentioned jobs are going to be very, very, very important because if we start to see some surprise numbers on the unemployment figures, if that starts to increase, all of a sudden hawks and doves are going to get more dovish, and that's likely going to lead to them considering rate cuts more earnestly. Okay, so ADP jobs reports are coming out next Wednesday. BLS is going to be next Friday. We're also going to be getting updated inflation data. Like I said, June's inflation figures should, fingers crossed, please, be pretty cool. We should be getting some solid numbers, hopefully June 12th, June 13th, and then June 28th. After that, it's going to be very, very hard to make some meaningful progress on inflation. If the Fed's really going to start to consider cutting rates, it's probably not going to be on the heels of cooling inflation. It's probably going to be more on the heels of worsening jobs market. Okay, so one of those weird instances where, and it's kind of the world I live in, unfortunately, it's very, very weird for me. I always feel like devil's advocate, but bad news for unemployment would actually be good news for mortgage rates, good news for consumer debt rates likely as well, as they likely consider a Fed rate cut in the horizon. So going to be very, very, very interesting to see what happens. This next meeting is an important one. Even though the Fed's not likely going to change their Fed funds rate, they are going to be coming out with a lot more guidance on what they think is going to happen. So that updated Fed dot plot, When does the Fed think they're going to start to cut rates? How far do they expect? We're going to be all eyes on that report, finding out any pieces of data we can pull out to find out when the Fed's likely going to start to cut rates. Like I said, I think it's probably going to be that September meeting, but we shall see. That is it. Very, very busy month. Very eventful. Night and day difference from the month before. So I think that's it. If you have any questions, let me know. If you have any feedback, always appreciate it. And thank you all so very much for all of your support. It means the world to my team and I. We cannot do what we do without you. So thank you all so very much. All the referrals, every single time, we appreciate it greatly. So thank you all so much. And have a wonderful weekend. Have a wonderful rest of your month. And I will see you next time. Thanks so much. Bye.